Okay, now we're having a look at inventory adjustments and the entries that we need for balance day for this. We spoke earlier about why inventory adjustments are really important and having good knowledge of your stock levels. So your general journal entry to record a shortage is a debit to inventory adjustment and a credit to inventories control. So inventories is the asset account that is going down because we've realized we have fewer inventories than what we thought. So that is why that asset account, which is debit by nature, is being credited to show that reduction. And the inventory adjustment is an expense account that's going up. So that is debited just like the nature is a debit. And then it's the opposite for when we've got a gain. So the inventories are going up. That's an asset account. It's more than what we expected. It's going up. And the expense account is going down. And then the inventory adjustment for an inventory shortage appears in the statement of profit or loss beneath the cost of goods sold figure. So we've got sales at the top, then we've got that line that's just less cost of sales, and beneath that, so that doesn't have any figures on that line, that's just like a heading. And then beneath that, we've got cost of goods sold and inventory adjustment for whatever amounts are relevant. And then that allows you to figure out the gross profit based on those figures. So inventory adjustments, inventories can be valued at cost, which usually is referring to historical cost. So whatever it is that you purchased the inventories for. But they can also be valued at net realizable value or NRV as our acronym. So this is the selling amount that a business predicts it could receive for the item. And it is part of that is subtracting all of the predicted marketing, selling, distribution expenses that are associated with that sale. And then, of course, the lower of cost or not net realizable value is exactly the way it sounds. So the business is determining the cost and the net realizable value figures for the inventories. And then it's using the lesser amount in the records. So you work out both next to one another, and then you go, which one is less, and we'll choose to record whichever one is less. So here we've got some inventories that were purchased, a bunch of different inventory items, A, B, and C. We've got $400 worth of A, $200 of B, and $900 of C. And then we've got the business's sales for the accounting period were $6,000. The cost of goods sold was $2,000. The following information was known about the business at the end of the accounting period. So the inventory item, we've got the cost $90 worth of that item A. So we did buy 400, but at the end of the accounting period, we've got $90 worth of item A left. And then the lower of costs, so the net realizable value is 120. So we choose in that last column, you can see we're identifying which one is lower out of NRV and cost. So in this first example for item A, it's cost $90, and that's what we record. Item B, the lower one is NRV, so the $40 is what we record. And then again, cost is lower for the last one, so that's what we record. And then we come in and calculate the total for each column, the cost column versus the lower of cost and NRV. The difference there is $30 between the two totals. And that's the figure that we carry through in our inventory adjustment. So you can see in our statement of profit or loss, we with just using cost, it is very straightforward. You've got your sales of 6,000 that we were told we had, and you've got your $2,000 worth of cost of goods sold. But when you're using the lower of cost in NRV, you are including the inventory adjustment for the $30, because that's what we identified as the difference between the two. And that slightly changes our gross profit figure. So the $30 loss would be recorded in the general journal with this general journal entry. Inventory adjustment is going up because we're doing the adjustment, and then the inventories are going down by the 30. So this reduces the inventories account by $30. So meaning that the inventories would be recorded as $310 instead of $340. So the 310 is what we got from this amount here, the lower of cost and NRV. We calculated as 310. That is what is included in our as our asset amount for inventories in the financial position statement.